afternoon, everyone, and welcome to our pension auto-enrolment webinar. My name is Susan Wiley, and I head up the Accounts and Business Advisory Services team here in Azets, which incorporates our payroll department. The payroll department is led by Jennifer Kelly, Anne-Marie Fagan, and Anne Carolyn, who over the past few months have been getting our payroll clients and our systems ready for pension auto-enrolment. Now that we know that pension auto-enrolment will commence in January 2026. The recent report from the Department of Finance shows we currently have 116 people in the labour force for every 100 not working. The projection for 2065 will be 98 people working for every 100 not working. So with the expected surge in the number of older people as a proportion of the population, the government is aware that it needs to look at healthcare, long-term care and pensions. With regard to the pensions issue, most observers would agree that pension auto-enrolment is a welcome reform. It is moving Ireland closer to international best practice and will help future-proof retirement security for low and middle income workers and reduce the dependency on the old age pension. That said, there are still a lot of questions about pension auto-enrolment and how it will operate here in Ireland. So we're delighted today that we have Paul Ord, an assistant principal with the Department of Social Protection, with us today, who will talk us through My Future Fund, which is Ireland's auto-enrolment retirement savings scheme. Jennifer Kelly will also talk through some of the issues that employers may face in connection with pension auto-enrolment. And at the end, we will have a Q&A session. And so please put any of your questions in the chat box and we will get to them at the end. We're starting now, and as I say, we will have a closeout at 3 o'clock. And so we will have 20 minutes to half an hour at the end of Q&A. Over to you, Paul.
Thanks very much. So my name's Paul, and I'm just going to give you a brief overview of My Future Fund, including the eligibility, the contribution rate, and how the scheme's going to work. So go to the next slide, please. So employees that will be eligible for auto-enrolment will meet these three criteria. The first one is that they'll be earning over €20,000 per year across all employments. The second one is aged between 23 and 60. And the final one is that they're not already paying into a pension scheme through payroll. So it's important to note that employees who earn less than the €20,000 a year but are aged between 18 and 66 can opt into My Future Fund, and they'll be able to do that using the online portal. All employees whose pay is reported to revenue in the Republic of Ireland are potentially eligible for My Future Fund, and what that means is that factors like contract type, contract length aren't going to be taken into consideration, which means seasonal workers and part-time workers, workers on probation, etc., will all be considered for the eligibility test and will also be able to opt in. Currently, people who are self-employed or not currently working and earning won't be eligible to be auto-enrolled, nor will they be eligible to opt in. So the next slide, please. So we get a lot of questions around multiple employment. It's one of the more, I suppose, complex areas to talk people through. And what we tend to find is that just giving an example works a bit better than a long-winded explanation. So we can see in this example that in job A, they're earning €10,000 a year. In job B, they're earning €15,000 a year. So each of those employments individually wouldn't come to the 20,000, but the aggregated combined salary of 25,000 a year would bring them up to the threshold to be auto-enrolled. So assuming they meet the other eligibility criteria, they'll be auto-enrolled. Now, as we'll go into the contribution rates in just a little bit, but you'll see here that we're starting off at 1.5%. So that means there's 1.5% of gross pay as a contribution from the employee, matched by the employer, and then the state tops up by 0.5%. Each of those employments will pay on the percentage that they pay the employee. So that's going to equate in total to €375 contribution from the employee, the same from the employer, 125 from the state, which means an annual contribution in the first 3 years of €875. Next slide, please. So we'll just take another example here. So this is an example where there's an existing pension payment through payroll in one of the employments. So job A, no pension. Again, €10,000 per year. Job B, there is an existing pension and they're being paid €15,000 a year. But this is to show that even if one employment has pension coverage, it's still the combined total that'll be taken into account when we're doing the eligibility checks. However, the gross pay from job B won't attract a contribution from the employer or the employee or the top up from the state. So in this example, again, we're looking at the 1.5% from the employer, and that'll be paid on the 10,000, 1.5% from the employee and 0.5% from the state, which means a total annual contribution of €350 towards the employee's My Future Fund savings pot. So this might add a little layer of complexity in people's eyes to the calculation, because it's taking into account people with multiple jobs and even where there's existing pension coverage. But I suppose it's two things to say here. Firstly, employers don't need to worry about determining that eligibility. That's going to be done by NERSA using revenue payroll data. And secondly, employers won't necessarily need to know if their employees have another job, but it will be something that they should maybe consider and be aware of in the case that you are paying someone, you don't think they're at the threshold, they might very well have another employment that would bring them into the scope for enrolment. So next slide, please. So here we see the contribution rates. They're going to be fixed as outlined in this table. They'll be phased in over the first decade of the introduction of auto enrollment. So remember, that means it's not going to be in the first 10 years of an employee's enrollment or the first 10 years of an employee's career. It's from the point that auto enrollment goes live in 2026. An example of that, I suppose, is if someone joins in 2033, they'll start paying immediately at the 4.5% rate. If they join after 2035, they're going to be paying at the 6% rate. Now, it won't be possible in the initial years at any rate to contribute more or less than these, but that could be something that NERSA would look at in the future. Contributions are being phased in like this, I suppose, with consideration to both employers and employees, make it easier for them to budget for this, starting at the low rate and slowly increasing up to the 6%. And again, another measure to help ease the cost is that contributions are going to be calculated up to a maximum gross pay of €80,000 per year. Contributions then will be stopped by NERSA through a payroll notification for the remainder of that year after the threshold's breached. And what we mean by after the threshold's breached, to give just a very small example on that, is say someone up to September has earned €79,000. They're due to be paid €5,000 in the next pay date. The full €5,000 will attract contributions. So it's once that threshold's breached rather than a hard stop actually at the 80,000 itself. Next slide, please. So just going to talk you through the opt-out, suspend, and re-enrollment options. And there's some YouTube videos on our channel that go into a bit more depth on these if you want to watch them. So the opt-out window will be available to employees in two circumstances. The first one is 6 months after their initial enrollment in months 7 and 8. They'll have the option to opt out. If they choose to do that, again, they do that directly through NERSA. There's no employer involvement in that. You don't need to worry about whether someone is or isn't going to opt out. You'll just get an updated payroll notification when they make that decision. So in that case, the employee would receive a refund of their contributions up to that point. The employer and state element will stay in the employee savings pot and will continue to be invested for them. Then after 2 years, NERSA will look again to see whether they're still eligible, and if they are, they'll be re-enrolled. The second opt-out option is in months 7 and 8 after a contribution rate increase. Again, there'll be a refund due to the employee, but this time it'll be the difference between the old and the new rate. This again, it's been done on the basis of sort of affordability for people. But just like the other opt-out option, after 2 years, nurse is going to look back. If you're still eligible to be enrolled, you're going to be brought back into it. And again, employers don't need to worry about tracking this. They'll be notified through an updated payroll instruction. The suspend option then works a little bit like the opt-out with, I suppose, two key differences. If you choose to suspend, it has to be after the 6 months mandatory participation, but you can then choose to suspend at any time. There's no window for suspension. It's any time past that 6 months. The second difference would be that if you choose to suspend, there's no refunds due because you're just taking a break from the contributions. But like with the opt-out, when you do suspend, the employer contributions are suspended as well, and so it's the state top-up element from it. And the final thing for the to remember about the suspend option is it's for a minimum of 12 months, a maximum of 2 years, but you can also set a date that you want to come back in. So if it's the case that you need to, just stop contributing for a little bit to maybe save for something, you've got that option. As long as it's over 12 months, you can set your date to come back in. If you don't set a date, you'll be brought back in again after 2 years. So this is the re-enrollment element of it, again, managed completely by NERSA. They'll track people who opt out or suspend, keep track of them, and then if they're eligible to be brought back in, they will be after, I suppose, a maximum of 2 years of being out of the scheme. And again, employers won't need to worry about this. It'll be notified to them through an updated payroll notification, and employees will be able to opt out and suspend using the employee portal. So again, it's not an administrative piece of work for the employers to manage. So the next slide, please. So we'll just look at some of the key features of My Future Fund. Now, a lot of these have been developed based on learnings from other jurisdictions. The first one I want to highlight is the portfolios member approach. And this feature was developed exactly like that based on learnings from other countries. What it means is that employees will have a single pot in My Future Fund, even if they move jobs a lot throughout their career. If you have multiple jobs at any point, you're still just paying into a single pot. And what that means is employees and employers don't have to worry about tracking pots that could be sitting around one central pot, and it sort of eliminates the risk of small pots being eroded through fees. The second feature is to make the savings go as far as possible. They'll be invested on behalf of the participants. There have been 3 investment managers selected through a procurement process, and they are Irish Life Investment Managers, Amundi, and BlackRock. Each of the investment managers will offer a high, medium, and low risk fund, and they'll go towards forming the basis of the 4 fund strategies. So as well as a high, medium, and low investment strategy, there'll then also be a default strategy that everyone's going to be placed into to begin with. And that default strategy will work on a life cycle basis, which means essentially that it de-risks the closer people get towards retirement. So you start at high, move to medium, and then low, taking advantage of, I suppose, higher risk growth in the younger years and the stability of low risk growth as you get closer to retirement. And it's just a way to allow participants to get a good retirement saving without having to make complex financial choices. I think there's a piece actually in the Irish Times today that really highlighted there isn't a huge amount of financial literacy around pensions for people. So this option just means that nurse is going to take care of managing that on your behalf. And sort of after all the saving and the investing, they've built up a pot for retirement. The retirement age for My Future Fund is going to be linked to the state pension age, which is 66. And in the initial years of the scheme, retiring employees will receive a lump sum payment from their pot. And again, that's being done given that the size of the pot, certainly in the early years, are going to be quite small. The lump sum makes sense in that case. Going out to the market to try and get an annuity with it probably wouldn't be worth your while, or phased payouts again wouldn't make sense. But it's very likely in the future that nursery are going to develop other retirement products as time goes on. I suppose another important point to note here is that unlike other countries, employees won't be able to access their pots before retirement age. This has been done to ensure that those savings are going to be ring-fenced for them for when they reach retirement. Now, early drawdowns will be possible, but only in the case of an ill health retirement. And in the unfortunate event where an employee was to pass away before retirement, their pot will then be crystallized and will form part of their estate. So next slide, please. So, like I mentioned, a new body, the National Automatic Enrolment Retirement Savings Authority, or NERSA, is or has been set up now to administer My Future Fund and it has a board that's answerable to the Minister and Oireachtas, and it's going to be supervised by the Pensions Authority. Now, NERSA is going to bear the bulk of the admin work for My Future Fund, and just to give you a little example of that, I'll just go through some of their functions right now. So NERSA will determine an employee's eligibility for My Future Fund using revenue payroll data. They'll then inform employers through an auto-enrollment payroll notification, or an AEPN, when an employee's been enrolled, and that notification will contain the contribution percentages that have to be applied. NERSA then collect the contribution, the employer and employee contribution directly from the employer, and will collect the state top-up separately. Those contributions are then pooled and sent to the investment managers based on the participants' chosen investment strategy. NERSA will also manage the re-enrollment and exempt employment. So again, this isn't something that employers will have to worry about. Employees go to the employee portal and they'll be able to select those options. Then NERSA will track them to ensure that they're completed and that they're re-enrolled if and when that time comes for them. Like I said, those contributions are sent to the investment managers. Part of NERSA's role as well will be to manage the contract for investment managers, making sure that they're adhering to the terms and conditions of the contract. NERSA will then pay out the savings to retiring employees. Like I said, initially that's going to look like a lump sum payment, and those will be treated, and it's been legislated for that they'll be treated in a similar way to PRSAs, the way they're treated right now. So you've got your tax-free lump sum, and then after that, given the size of the pots initially, it's likely that the trivial tax treatment for pensions will apply to any remainder of that. NERSA are going to monitor compliance with the scheme, and this is probably an important one to note. They'll have a pretty robust compliance function. And for employers, it means a couple of things. Maybe first and foremost, it's paying over contributions when they're due to be paid over. So that's going to be no later than 6:30 p.m. on an employee's pay date. That's the date that the money hits the bank for the employee. It also means that there'll be fines and penalties in the case that employees are forced to opt out or suspend, or if they're penalised for their participation. Employees will have recourse through the WRC in those cases. And lastly, NERSA are going to manage public area websites with information on My Future Funds, as well as the employer and employee portals. So employees will be able to log on using a verified MyGov ID they'll be able to see their contributions, their investment growth, and that'll be updated on a daily basis. For employers, and we'll get to this in just a little bit again, but this is the case that the employers will have to log on and complete their profile in December when those portals go live. And what that'll mean for employers is they can set up a payment method at that point. What we'd suggest is a variable direct debit to make life as easy as possible for employers and for the sake of compliance and paying over those contributions. So once they've set that up, it sort of takes 5 minutes, a few details to put in. and then you'll be set up and ready to go. But you'll be able to check your contribution record, update your contact details, and update your payment details as well. And to support people along with this, there'll be a contact center made available to both employees and employers. We go to the next slide, please. So this is just a little infographic that gives us an overview of how the system's going to work. So contributions are collected by NERSA, who then pool and allocate them to the investment managers according to the employee's investment strategy. The investment managers then invest the contributions, generate returns, and they'll then be allocated to the employee's savings pot. And then finally, NERSA, when someone gets to the age of 66, they pay out the savings to them on retirement. So next slide, please. So I'll just give you a bit more detail on that process. So revenue are going to use, NERSA are going to use revenue payroll data to determine eligibility. And what that means is they'll be taking a 13-week look-back period of revenue payroll data, and they'll be assessing that on a prorated basis, see if someone hits €5,000 in that period, which they'll then determine that they're likely to make the 25 or the €20,000 over the course of the year. Once that happens and someone meets the rest of the eligibility criteria, they'll be enrolled by NERSA. So for a lot of people, this will be pretty quick if you've already got an earnings record with revenue. But for new employees, it could take up to 13 weeks before someone's enrolled. So NERSA will then generate the auto enrollment payroll notification, or the AEPN, and that'll be issued through payroll. The employer will be able to get the latest and download the latest AEPN, and then contributions are applied, contribution files returned no later than 6:30 p.m. on the employee's pay date. NERSA then collect the contributions, and those are pooled and sent to the investment managers for investment for the participants. So next slide, please. So we'll just give a little overview of how that's going to look, maybe from the point of view of an employer or a payroll operator. So employers or their payroll operators will get latest AEPN through the payroll software. They'll then apply the AEPN and return the contribution file through the software no later than 6:30 p.m. on the employee's pay date. Employers will have to make sure that they pay the contributions on the same day that the employee's paid. So again, what we're saying is the easiest way for people to do this is to set up a variable direct debit on the employer portal when you're doing your onboarding. And if it's the first time an employee's been enrolled, employers will also then have to inform the employee of their enrollment and of their enrollment date. Again, we're trying to make this as easy as possible for employers. And what that's going to look like in the portal is that once the AEPNs are generated, there could be about a day lag for this, but employers will get a push notification about it. And what we're going to do is generate those letters for each individual employee in the employer the employer secure mailbox on the portal. So it's providing that resource so you don't need to go out and worry about drafting this yourself. The information in those will be sufficient to inform the employee. You download them, you can print them off and post them to people, you can put them in people's hands, you can email them to people, just as long as you get them out to them. So the next slide, please. So because NERSA is managing the bulk of the admin, sort of as we covered earlier, what we're saying is that it's going to be as easy as 1, 2, 3, and you'll see this in our advertising campaigns sort of going forwards now. So it's 3 easy steps for employers to complete in advance of go live. The first one being to complete your profile on the portal when it opens in December. We're working on a range of communications that'll go out to employers to let them know exactly when that facility is open for them to do. Step 2 then is to set up a payment method. You'll be able to do this at the same time that you're setting up your profile on the portal. We've done a walkthrough on this for people at an in-person event just recently, and it really did show up. You're looking at sort of 5 minutes out of your day to set this up, set up a payment method. And what that means is then, you're sort of almost ensuring that you're going to be compliant when this starts in January. So if there's one message to take away from this, it really is when this facility opens, go along to the portal, complete your profile, and set up your payment method. And then the third step is to run payroll as usual, and just remember that those contributions will begin on the first pay date in January. So I'm sure a lot of you will be working with payroll software companies. They're facilitating an awful lot of this to make it again as automatic as possible. We've worked closely with them to finalize those specifications. And then for any employers, I suppose, that don't use payroll software, they'll be able to download the APN, upload the contribution file through their account on the employer portal. And the third option will be to use submission screens on the portal to manually input employee details. So employers won't have to worry, I suppose, about who should or shouldn't be in My Future Fund. That's going to be communicated to you through this AEPN. So next slide, please. This is the scary one, I suppose. This is the compliance end, and like I said earlier, NERSA is going to have a robust compliance function. And employers will have some responsibilities because automatic enrolment is an employment right. It's set out in legislation. So there'll be a number of protections, including fines and penalties for employers who prevent their employees from opting in, force them to opt out, or suspend their contributions, or penalize them for their participation. Again, employees will have recourse through the WRC in the event that any of that happens. Any withheld or underpaid contributions will attract interest payments. And again, that's important to remember that hard cutoff date or cutoff time of 6:30 p.m. on the employee's pay date. The penalties and fines for non-compliance, they're set out in legislation in chapters 5 and 6. The objective of those measures really is to deter evasion and encourage prompt payments of arrears. Then in Part 9 of the Automatic Enrolment Retirement Savings Act, it provides for a wide range of powers to NERSA to conduct those compliance and enforcement functions. But again, it might sound like a broken record. The first step that I think all employers and their payroll operators should be taking is to get along to the portal when it opens, get yourself registered and set up a payment method before January. So it's just, I suppose, important that employers are aware of these obligations because there is the risk for non-compliant employers that they could face prosecution. So next slide, please. So on I suppose a lighter note here, obviously we talk a lot about the benefit to employees with My Future Fund, but there's also benefits to employers. So one of the main ones is that employers can look after their employees in retirement without having to worry about setting up their own occupational pension scheme. And in fact, when you look at the amount of admin covered off by NERSA, especially compared to running your own scheme, this is going to be a lot less work. It increases the competitiveness and attractiveness of employers in what's a tight labor market, and increasingly, I suppose, an international labor market when you're trying to attract talent, to be able to say that you do have as standard a quality assured retirement savings scheme in place. And also finally, important just to say that for companies that pay corporation tax, employer contributions will be deductible for corporation tax purposes. So next slide, please. So we're getting towards the business end, I suppose, of My Future Fund implementation, but there's a few things for employers to do in advance of go live. The first one, I suppose, that people can do right now is to start looking at your budgets and to budget for My Future Fund contributions from January onwards, and looking at those rate increases as time goes on. So most employers will have a pretty good idea of who meets the age and earnings threshold. But again, it's important to remember that multiple employments element and the fact that employees can opt in if they want to. The second one, we're coming back to the employer portal profile. We're asking you to go along to that again in December when that launches, and to complete your profile before January 2026. This is probably the most important step you can take to make sure that you're going to hit the ground running and are going to be compliant with the legislation and the rules of the scheme. The next one, I suppose, is to look at your current pension coverage. If you have an occupational pension in place, and you would rather all your employees are on that, now's the time to start talking to those employees. Of course, being cognizant of any sort of implications that would have on existing contracts and employment laws that already exist. Next, it's to update the payroll software when those updates become available later in this year. Again, we've worked very closely with payroll software companies. We're constantly testing with them to make sure that this system is going to be running and going to be smooth for you. But again, it's important to link in with whoever's providing your payroll software for you, so they can take you through any additional steps that you might need to take to ensure that you're making the contributions, applying the APNs correctly, and everything like that. And finally, we'll be talking about talking to your staff about these changes. There are going to be contributions coming out from any enrolled staff from their first pay dates in January going forwards. So it's probably important now that as employers you start to communicate to your employees about that there will be a 1.5% deduction from their gross pay from their pay date if they're enrolled. So next slide, please. So there's a number of myths or pieces, I suppose, of misinformation that have been out there about My Future Fund. And it's important that as employers and payroll operators that you have the most up-to-date and accurate information. So the first one is there's been a lot of talk about the administrative burden of My Future Fund. Now, what I hope I've shown you so far is that this really isn't going to be the case. Again, NERSA is going to manage the bulk of the admin burden, including identifying eligible employees, enrolling them, managing the opt-in, opt-out, suspension. All of that will be done directly by NERSA, so employers don't have to worry about that. If we look over the water at the UK example, I think maybe that's where some of the fear was coming from, where there is a bigger admin burden for employers to think about. We've looked at that, we've taken those learnings, and that's why we've built, I suppose, what is a simpler system for employers to interact with. The second one is around costs. Now, I've mentioned that contributions are being phased in gradually at the 1.5%. That again was done to be cognizant of any increase in business costs, and the same as the cap on the 80,000 euro earnings threshold. So while there will be a modest increase in costs, what we've seen, again, looking at international evidence, and the Australian Parliamentary Budgetary Office have a good report sort of outlining this, is that as those contribution rates increase, they tend to be absorbed into normal pay negotiations. So you're not looking at, a 6% increase in your wage costs in year 10. It's actually, probably far less than that once you consider all the factors and the effect that this is going to have more generally. I suppose the next one is a big one for us, and that's the claim that this is intended to replace a state pension. That's one that we really want to be strong on here, that absolutely not. The state pension will remain the bedrock of the Irish pension landscape. Auto enrolment, or My Future Fund, is intended to sit alongside it and supplement it just like any other occupational pension would. The state pension, contributory state pension, only looks at PRSI contributions and nothing else. So My Future Fund, any My Future Fund payments aren't actually going to affect that. Probably important as well to say, as was pointed out by Susan at the start of this, we're looking at changing demographics. If anything, My Future Fund is a great way to insulate the National Insurance Fund. We're going to have more people retired than working in 2065. But what this means is that those people will have retirement savings, so they won't be as reliant on the state pension. The final one then is that the state might use these savings for another purpose. And again, we can say categorically that's not the case. In the legislation, these savings are the sole property of the participant. So it means it has protections under that legislation and constitutional protections, just like any private property would have. And it means no one can use those savings for any other purpose other than what they're intended for. So next slide, please. So we get a lot of questions, as I'm sure you can imagine, from employers and payroll operators, and we're looking forward to answering a few more at the end of this presentation. But I just want to go through a few of the most common ones right now. So the first one is around the look back period. So I just want to explain again sort of what that means. Look back period is a 13-week rolling look back period where NERSA will consume revenue payroll data to determine eligibility. The 20,000 euro is prorated to 5,000 euro over that 13 weeks to assess whether it's likely someone will earn the 20,000 euro in the year. Once they've hit that 5,000 euro, assuming they meet the other eligibility criteria, they'll be enrolled. And that works as an enrollment trigger. What that means is if someone earns less than 20,000 euro a year at any point, they'll remain enrolled in the system. They won't drop off because their earnings fall below the 20,000 euro. The next one, and this has been a big one, I suppose, for us with payroll software developers and discussions with them and with revenue. We understand there's a large corrections process for revenue. That won't be the case for My Future Fund, and there's a couple of good reasons for this. I suppose one of the first ones is the simplicity of My Future Fund in the way the contribution rates are applied. Everyone pays the same rates. You don't need to worry about maybe when you're returning or paying tax. There could be tax credits to consider. There could be, different tax rates, the standard rate, the marginal rates, and where those get applied. That won't be the case for this. It's a singular rate for everyone that's enrolled. Now, what this means in practice is that you'll have to return the contribution file no later than 6:30 p.m. on the employee's pay date and pay the contributions at that time as well. Once that time's passed, NERSA won't accept any amended contribution files. Now, you can amend contribution files up to that point, but it's after that point that doesn't happen. So another reason for this is that as soon as NERSA receive the contributions, they'll be sending them to the investment managers to be invested. So if there was a lot of sort of backpedaling and disinvesting, that would run the risk of sort of participants missing out on investment growth. Now, we will obviously have to divest in the case of refunds where they're owed to the employee. But again, if we're doing it all the time, it could have a profound effect on the investment growth of those savings pots. So the best way for us to do it is to set a hard deadline. Now, if incorrect information, like an incorrect PPSN is submitted, NERSA will look to rectify that sort of thing. And lastly, and this is you'll be glad it's a much shorter answer on this one, whether tax agents operating on behalf of their clients are able to access the portal. Short answer is yes. So they have a TAIN that they'll be able to use with their normal revenue credentials. So I think it's a ROS Prem cert they'll be able to use to log in as they would on Revenue Online to sort of take care of tax affairs of their clients normally. So just before, sorry, next slide, please. Just before we finish up, I just want to reiterate these 4 points that employers should be considering. So the first one, again, sorry to keep banging on about it, but probably the most important one for us right now is that employers, when that facility opens, they go along to the employer portal and they complete their profile and set up a payment method. That's going to have to be done before January 2026. Again, we'll be communicating with employers and using, different stakeholder groups as well as communications campaigns to get that message out when that's open. There'll be supports for employers, the contact center that I mentioned earlier. We've developed an employer handbook that'll be that'll be shared as well, just to help employers go through that. Employers that haven't done that are running a risk of being non-compliant come January. And again, everything that carries with it in the form of fines, penalties, and potential prosecution. So the second point is that there are not going to be no minimum standards for my future fund, at least on a day one scenario. Or no minimum standards for existing pension schemes, should I say. So what that means is, as long as there is any pension payment through payroll for an employee, either from the employer, or both of them, any payments at all recorded in payroll will mark that employment as exempt. And again, NERSA will be consuming the revenue payroll data, so they'll be able to see those exemptions, and they then won't enroll. Now, I suppose, and this is linked to the second one here around waiting periods. Auto enrollment doesn't operate waiting periods. We're aware that an awful lot of occupational pension schemes do. There's a couple of options for employers in this case. They can either live with the fact that some of their employees will be auto enrolled, or they can, talk to your pension provider and look at, getting rid of those waiting periods. Now, if someone is enrolled into my future fund and they subsequently become eligible and want to join the company scheme, they can do that at any point. You don't have to wait the 6 months of mandatory participation, because once NERSA again sees that pension contribution through the revenue payroll data, they'll then exempt you. What that can mean is it's likely in certain cases there'll be overlapping contributions for a pension. But again, you don't need to worry about this. That's all refundable. Both the employer and employee elements of those overlapping contributions will be refundable through NERSA. And then lastly, again, it's important to look at the fact that income from multiple employments is going to be assessed for the eligibility checks on my future fund. So while again, you might have employees that are earning below 20,000 euro a year, it's just important to consider that they could have earnings outside of your employment, and that could bring them up over the 20,000, which means they would be enrolled. NERSA is going to manage this, so you don't need to go out to your employees and ask them if they're working other jobs. You'll get an updated AEPN to indicate whether they've been enrolled or not. So just before I finish up, sorry, next slide, please. Just before I finish up, I just want to highlight a couple of the resources that we already have available. So our website, which is gov.ie/auto enrollment, is sort of the primary and official source of information available online on my future fund. There's good sections there on for employees, sections for employers, a page for frequently asked questions, and we also have a latest news section that has updates on the progress of the project, as well as any webinars that the departments are hosting. So next slide, please. You'll be glad this is the final slide from me. So we also then have a YouTube channel, referenced it earlier on. We have informational videos there that break down different elements of my future fund, so you can watch them all together if you're in the mood for it, or you can go into each individual video. They're all about 2 to 3 minutes long, so they're nice sort of bite-sized chunks, and you can learn a bit more about my future fund and how it's going to work. And lastly, if you do want to get in touch with us, if you have a question you want to ask us directly, you can do that at autoenrollment@welfare.ie. So that's it from me, and I'd just like to, I suppose, thank you for your attention.
Thanks a million for that, Paul. I'll give you a few minutes to take a quick break before I bombard you with all the questions that have been coming through. And just in the meantime, Jennifer Kelly is going to run through a few points from the employer side of things.
Thanks, Susan. So, yes, my name is Jennifer Kelly. I'm the Director of the Payroll and Outsourcing teams here in Azets. And I just want to reiterate a couple of the important points that employers really need to act on now if they're going to avoid unintended consequences. So, as Paul has already mentioned, the most important step really is to get registered on the portal. And if you're a current payroll client of Azets, we will be able to look after that for you, and we'll be in touch shortly regarding that when the portal goes live. Depending then on whether your payroll function is looked after in-house or by an outsourced provider, Have you confirmed that they're ready for the upcoming changes? And can the payroll software that they're using deal with the new requirements? So if you're already a payroll client here at Azets, I can confirm we are fully ready for all that will be required. Has your HR team considered if employment contracts need to be updated? So for example, if you're now putting an occupational scheme in place, you will need to include the agreed employer and employee contributions in the contract. It is essential that you're communicating clearly with your staff as soon as possible so that they're aware of how and when they will be impacted. Transparency really is key. Do your staff understand if they will be eligible? Do they know how much will be deducted from their pay and what the tax implications might be for them? For you then as an employer, have you budgeted for the additional costs of employer contributions and how is that going to affect your cash flow? So don't forget that payments are going to be made in line with pay dates. So for example, employers who pay their staff weekly or fortnightly will need to ensure you have funds available for the employer contributions at each pay date. It won't be like PAYE where you get to wait till the end of the month. If you're weighing up whether to put an occupational scheme in place, we've included a worked example in our employer guide. So please contact us if you haven't already received a copy. So moving on then to the next slide. The key deadline for employers to consider really is 30th of November, because if there are no contributions in November's payroll, your staff will be automatically enrolled in January. There's still time, however, to set up a company scheme, and the team here in Azets can help to put you in touch with pension providers or advisors if you don't already have one, so please don't hesitate to contact us. So some considerations then when deciding between a company scheme and auto enrolment. So an occupational scheme is much more advantageous in the long term for higher rate taxpayers. And again, I refer you to the worked example that we've included in our employer's guide. An occupational scheme offers greater flexibility and control. For example, contribution rates can be tailored, there are investment choices and retirement options, and worst case scenario, in tough times, employers have the flexibility to reduce their contributions. Many occupational schemes then offer additional perks such as death and service benefits, which aren't currently available under auto enrolment. Under auto enrolment then there is a cap of €80,000 on gross salary. So again, for higher rate taxpayers, an occupational scheme would offer more flexibility. Under most occupational schemes, if an employee leaves within the first 2 years, the employer may reclaim their pension contributions. This won't be possible under auto enrolment as those contributions will be locked in. So a few points for employers to consider there, and unfortunately not a lot of time to consider them before the end of the month. And I can see we've got plenty of questions coming in, so I'll hand back to Susan now, who will start running through them.
Thanks, Jen. Paul, we've had a few questions for people asking if you have an employee over 60 who wants to continue contributing to auto enrolment, is that allowed by the scheme?
Yeah, absolutely. So I suppose maybe just to outline again, the 23 to 60 is to be automatically enrolled, and there's a tiny bit of nuance on that. It's 23 to 60, but what we're actually talking about is over the age of 23 and 59 and 6 months is going to be used as the cutoff period. But outside of those age limits for auto enrollment, someone can always opt in. If you're already enrolled, you'll stay enrolled until the age of 66, obviously, unless you start paying into another pension through payroll, or if you leave employment.
When you mentioned the drawdown amount when somebody is 66, someone just wants to confirm, will the lump sum be tax-free?
The lump sum will be tax-free up to a certain point, the same way the PRSAs are treated currently. So off the top of my head, I'm probably not going to give you the figures, but they're if you look at the tax rate in PRSAs and you're familiar with that, that's how it's been legislated to be treated.
Will be treated no different than current lump sums coming out of private pension funds.
Yeah, that's the idea.
Again, somebody asked a question about can you opt out on the 1st of January? I understand no, everyone has to go in for the first 6 months and can opt out thereafter. Is that correct?
That's exactly right when we're talking about the opt-out. Same for the suspension. You have to wait 6 months before you can do it. The opt-out is then that window, months 7 and 8, that you're able to opt out. Maybe something to just point out again though is if you did join an occupational pension scheme, an updated APN would be sent to the employer with a contribution of 0 in relation to that employment. So that would effectively opt you out of it, but just to opt out and not to join another pension scheme through payroll, that wouldn't be possible.
Question here about an employee, again, earning over 20,000 already in an existing scheme, and employer and employee contributions going in. Just want to confirm that they'll be exempt from auto enrolment once it's got running through the pay slips.
Yep, exactly. Once those contributions are made through the payslip, it means it's reported to revenue, and NERSA will be able to see that. I suppose maybe that just leads me to another point, is that if contributions are being made not through payroll, and there are, situations where that's happening, someone might have a private pension themselves, or even there are arrangements within companies where they might pay a pension to someone not through payroll. They won't be picked up by NERSA. So it's very likely that someone in that case would still be enrolled. So there's a couple of options that you can look at there. You can look at normalizing that and have it done through payroll if you didn't want to be enrolled. The other option is you can continue paying into that private pension outside of payroll and pay into auto enrollment as well.
That is a question that someone had asked earlier today. They have an existing PRSA that they're paying for privately, not going through a company scheme. And for them, their option is ask the employer to put it through the payslip, or they could stop the PRSA and just go through the auto enrolment scheme.
Yeah, exactly. Or they could keep paying into the PRSA and go through the auto enrolment.
As well.
That's the really the third option for them. Again, the auto enrollment legislation doesn't impede on, I suppose, employees' existing rights to request employers to facilitate a PRSA or pension through the company. So none of that changes. Equally, and I think this has been something that maybe was out there for a little bit, that there were some employers thinking that as long as they offered a pension scheme, that they would avoid auto enrollment. Again, that's not the case. And finally, so nor is it the case that employers are able to just, I suppose, scoop people up into an occupational scheme. That's something you really need to consider the employment law around. So we've heard that as an option that some people have suggested, and you need to look at your contracts. You need to really look at the employment law there, because if it's a unilateral decision by the company just to place everyone into a scheme, you're running a big risk. Well, I mean, you will be, I suppose, non-compliant with other laws and employment laws. So I suppose it's just important to highlight that. But again, talk to your employees if you think that it's more advantageous for them. Absolutely, we're not precious, I suppose, about how people get retirement savings. It's just a case of ensuring people have them.
There's a question here, and it's from an employer. They have all their employees in PRSAs, and they're just asking the question, do they have to register on the portal? My understanding is yes, all employers have to, even if they don't think any employees will be auto-enrolled. Is that correct?
Yes and no. I think sort of legally, there's nothing to compel you if you don't. But what we'd say is it's 5 minutes to do it. Absolutely do it, because even if all your employees are in a PRSA right now, you never know what's coming down the tracks, that you could end up with employees that aren't, and then it's at the back of your mind, they're enrolled, and all of a sudden you find yourself non-compliant without sort of sleepwalking into that non-compliance, and almost through no fault of your own. So we'd say get along to that portal, absolutely, and register, even if you don't think you're going to have employees in My Future Fund. The likelihood is down through the years, something will come up.
Okay.
Yeah. Just to add to that as well, I mean, we have to be aware of the multiple employments. You might think if they earn less than 20,000 that they may not be enrolled. They may have another job that you wouldn't know about, or they may like to opt in as well. So, you can't just categorically say that you may not have anybody enrolled. You're better off checking. Yeah.
Someone here has a company scheme, and there's an eligibility requirement that they have to be gone through a 6-month probation before they can go into the company scheme. So they're just asking what will happen during that 6-month period.
If NERSA deem that employee to be eligible based on the age, earnings, and obviously they don't have a pension contribution in that case, they'll be enrolled into My Future Fund. So this is again where we talked about My Future Fund not operating waiting periods. So again, as an employer, you have options there, either to live with the fact that they'll be enrolled, and they can of course join that scheme as soon as they want to. They could join it after 3 months if the waiting period was reduced. So that's the other option, is to either reduce the waiting period or get rid of the waiting period if you want to.
Okay, thanks for that. Somebody has an employee who currently is on unpaid leave, and they're just asking, is that classified as a suspension, or does that just mean because there is no income, just no contributions, but they're still auto-enrolled?
So I can't speak to that individual instance. If in the, I suppose, 13 weeks leading up to the 1st of January, they've been employed and they have a gross pay that would bring them over that €5,000 prorated threshold, then they could be enrolled. But again, with the note that if there's no gross pay, there's no contributions owed by the employer, the employee, or the state. So it's only taken on gross pay. If they've been on unpaid leave sort of in advance and they're not caught or captured in the 13-week look back period, they're not going to be enrolled at this point. When they return to work, they could be enrolled. Again, assuming they meet the age earnings and sort of the pension requirements that are already there.
We have one here who are asking that they're in a private scheme, and do they need to contact anyone regarding auto enrolment? I think you've answered that. That, as you say, there'll be a look back period of the 13 weeks, and if they're already contributing to a fund, they won't be auto enrolled.
Yeah. As long as those contributions are through payroll.
Through payroll, yeah. Somebody's asking about the S-rate PRSI directors. Just to confirm that they're excluded from auto enrolment.
Yeah, so they're marked as self-employed and they'll be excluded.
An interesting one here, and I think that as we've heard this a lot, people are just asking about the auto enrolment contributions based on gross pay. Just wondering, does it include the likes of benefit in kind, company cars and stuff like that people have, that's included in their gross salary?
Yeah, so what we're going to be using is the revenue definition of gross pay. So anything that's reported to revenue through PMOD as gross pay that goes into that field is going to be included. That could be benefit in kind, that could be share bonuses. Anything that's in that field will be used for the eligibility criteria, and it'll also be used for the contribution calculations.
Okay, there's question here about if somebody opts out after the 6-month period, is the refund of the pension contributions processed through payroll, or how is it dealt with, Paul?
No, so that goes directly to the employee. So again, this is a way to, I suppose, reduce the admin burden on employers. When they go to opt out, they'll either go through the employee portal. When they do that, they'll be prompted to provide their bank details to be able to complete that opt out process. Otherwise, through they'll have the option to contact nurses directly and go through a paper form route as well if they want to. But again, to complete that process, provide the bank details so that nurse can process that refund directly to them.
I know we have a few more questions there, but I am conscious that it's just gone 3 o'clock there, and we said we'd cut off at the hour. So I just want to thank Paul and his colleague Lisa for joining us today and for going through the presentation and answering all those questions. As I say, we will organise for the PowerPoint presentation to be emailed to everyone who registered for the webinar here today. And yes, just want to thank everybody who joined us.
Thanks very much.
Thank you.
Thank you.
Thank you.